Hello, how are you doing today? We are going to talk about the market structure and how that works in trending markets for today. The most important thing for you is that you should follow the market movement in every methodology you are using for trading, or in every way that you are seeing the market, and that doesn't change with the method of your trading. You should always pay attention to the order flow or the money flow of the market, or in the simple term, you should pay attention to the trend of the market. Is it upside or downside? One of the best and the most simple ways and the most powerful ways to identify the order flow of the market is using the market structure, because even the smallest pullbacks and volatility of the market is showing us where the market order flow or where the market money flow is pointing at by following the structure of the market, maybe in higher time frames or maybe in lower time frames. And today we are going to talk about supply and demand boxes and how we can identify the order flow of the market with those boxes or with the simple break-off structure. We talked about market structure and break-off structure and even the kinds of break-off structure in this channel, so you can go back and watch those videos in the playlists. Pay attention to playlists, those are important. And now we want to see how that really works in trending environments and how we can use that to identify the order flow of our market. Let's talk about market structure and its breaks again. In summary, we talked about this in the channel, but I'm going to explain that again. The last obvious low to the last obvious high is our primary structure. Don't make things impossible to learn. It's so simple. The last high to the low or the last low to the high that we are seeing on charts right now is our primary structure. It's better to anticipate that the market is going to continue its direction. For example, if the market is going to the downside, we anticipate that it is going to continue its trend forever. Literally think that the market is going to continue its trend forever and you will be more successful than every other traders. Anyway, so we have our primary structure. It's just our pivot points that is important for now. So when the low or the high, so this pivot point or this pivot point, when one of them gets broken with the market, for example, it comes and break the low, we anticipate that the market will start to pull back and then start to go lower. So the best strategy, the best mindset and approach to the market here is that when the low or the high gets broken, we try to catch the lower high, or when the high gets broken, we try to catch the higher low. So we are going to talk about that right now. In this episode, we are going to mark our primary structures. We are going to wait until the structure breaks, and we are going to just watch the market, how the market reacts after the break of structure. Case studies are always the best method to learn something new. So when you are learning market structure, just go and pay attention to market structure and try to see after the break of structure what happens in the market. Let's see that on live charts. So what we have here, first of all, we have this big structure here that got broken from this part, and we have our internal structure here that broke to the downside, and we have our minor structure here. It's based on you, your characteristics, and your way of thinking and looking at the market and the time frame you like to trade in. So you can either mark the major structure or internal structure or minor structure, and all of them is going to be okay if you use that appropriately. Let's see what happens. For case study and practicing, just mark your structures, wait until the structure breaks, and see how the market will react to this concept. It's better to study one concept at a time, and after that you can mix things up. Here the market broke here and here. Our protected high is here, so until that point we are trying to catch selling trades, and after that point gets broken, we can say that okay, the market will come down and goes up, but we have a break of structure here. So what we should do in these situations, it's simple. We can use, for example, our Fibonacci from here to here and here to the point that the pullback starts. I'm pulling it here and here, so we can see that, and you can see that it came back, it pulled back, and it went up in the 23 point of our Fibonacci. It's a little bit of pullback. I don't take these trades, but you can take that. I always wait for bigger pullbacks. Anyway, let's see what happens. So this pullback is going to be okay for me because it is now in the discount. When I measure this point to this point, I'm going to talk about discounts in this course, in this free course, but it touches our 50% and it went up. So this is a trade for me if I'm willing to take risks, and this one is a trade too because it came and it touched our 78%. Let's see what happens after that. What about now? We have our structure broke here, it went up, it came down, and it provided us with this trade. So now we have our primary structure from here to here, and we should wait until the market breaks one of them. It broke our high, so we anticipate that the market will come down and pull back to the upside. Let's see what happens. You can see the results. It's enough. In the future with this channel you can see that how these concepts work, because we have imbalances, we have liquidities, we have a structure, and we have fractal in smart money concepts, and fractal is one of them. So we can go to lower time frames and take trades here. Let's continue our work. It's from here to here. It's our primary structure. We should wait until the high or the low gets broken. We can see that the high got broken, and we wait until it pullbacks and it goes up. We have another point of structure here, so this leg and this leg are important for us. For example, we can use our Fibonacci's from here to here. It is on 38, and here to here it is on 62, and both of them are important for us. Let's see what happens. And don't think it is a stop loss. It is a very good trade, because we are going to use lower time frames to enter the market here. I can't go to lower time frames because it's year 2019. It doesn't provide me with the data, but anyway, I know that for sure that in lower time frames here or here, these are very good trades. They are going to provide us with 4 to 1, 10 to 1, 5 to 1 reward to risk ratio. Let's see what happens after that. You can see the results. Or if you think it is a stop loss, it's okay. The next trade is going to hit the moon. Pay attention to numbers. We are reaching the limit of this movement. Every movement has its limits. For example, 99 and 100 are important numbers here. Even the 98 500 is going to be important for us to. Why I use DXY or US dollar index? Because it presents the movement of all the stock of the markets. It presents the movement of euro to US dollar, and it presents the economy of the world itself, because it's US dollar. So when something works on US dollar, you can find other assets that it works on them too. Anyway, let's talk about this. You can see that it wasn't a break because it just shadowed our structure and came back. It broke here and just here, and it broke here right now. But if you are a lower time frame trader, or you pay attention to internal structures, you can say that it came down and it broke here and here, so it is our primary leg and it is our trade. But if you pay attention to higher time frames, it broke this structure too. We can see the results. It comes back, it pull backs, and it goes to the downside. It can go to the downside from this point again. Why? Because it wasn't in the premium or discount. You can see that it just retraced to 38% of this leg. But I always say that wait until this zone. Let me see, from 50% to 78%. It is our golden zone that I'm going to talk about anyway. So now we understand that when the market, for example, here is our primary structure, when the market breaks the upside, breaks to the upside, we can wait until it comes back and it pullbacks, and we can trade here. And for example, when the market after that comes and breaks downside, we can say that it is our structure, so we wait until it pullbacks and it goes to the downside. But what is supply and demand box? Supply and demand box is the same concept, but it's more graphical, it's easier to see, it's easier to use, and for more amateur traders and those who are new to the trading world, that are not comfortable with charts and with candlesticks and with these messy shadows here, they can use supply and demand box. It's a perfect way to see the market structure, and it's a perfect way to practice the market structure. What is a supply box and what is a demand box? So what in heavens is a supply box or demand box, if I use the expression right? It is the most important, the most powerful and practical thing in the markets. If you learn how to read this concept with your trading method, I mean, not just reading this concept is not going to be good in any way. You should have a trading method, you should have entry setups, you should have your POI selection method or point of interest selection method, and beside that, all of those things are not going to make any profits for you. But when you add this concept to all those concepts, it's when the magic happen, if I use the expression right. I'm sorry for my internet connection. You know, I talked about it a lot in the channel. We are in an internet blackout. I don't have a stable good internet connection, and that's why I'm doing my thing in YouTube and other social medias, so your support is much appreciated. Anyway, what is a demand box? If we want to start from here, we can see that our primary structure is from this point to this point. So we wait until one of these points gets broken. When this happens, maybe sometimes it's hard to identify this high or identify the break, or sometimes it's just hard to see the market how it is because of all the emotions and volatility of the market. What can we do here for make it more graphical and more understandable? We can go and pull our box out and put a box here from the high that gets broken and the low that is protected, or the low that broke the high. And I'm going to make it blue as a demand box. So you can see that the market break this demand box and goes up, it comes back, pullbacks most of the time into this demand box, and here we can find our higher low and trade the market. After that, what we should do is we should identify our primary structure. It is here to here, and we can see that the market break this high again. So we have our demand box here, the market starts to pull back, come down, and here we can try to trade. And after that the high gets broken, so from that high to this low is our demand box again. So the high that gets broken to the low that broke the high is our demand box, and the market comes back, pull back into that demand box and goes to the upside again. What is this? What does it mean? It's so simple that you won't believe it. It's the support and resistances of the market. They are being used as liquidity points. For example, somebody is going to trade right here in this support line after the break, and they liquid those traders with pulling the markets almost always to some lower points to take those traders out, and it goes to the upside. And it's the definition of the order block in higher time frames. It's just the fractal of the market. So an order block, what is an order block? It's the last upside movement before the last downside movement. What is it? It's a support and resistance in lower time frames. So these concepts are fractal, and they are becoming more sophisticated and more complex when we use them in higher time frames or in lower time frames and with each other. Anyway, let's talk about supply boxes. A supply box is when we have a low, it gets broken, so from that low to the high that broke the supply box is going to be our supply box, the low to that high of the swing. After that we have another supply box here. You can see that the market comes back and most of the time pull back to that box, another supply box, another supply box. So from the high that breaks the low to the low is our supply box. Let's talk about this on charts. So as I said, you have your primary structure from here to here, and if you pay attention and have a hawk's eye, you can see that we have here something that is some kind of primary structure, and we have a supply box here too. So these are important. Why? Because these are higher time frames order blocks, and this is our complete supply box. Now let's see what happens. It's case study. Don't try to predict the market movements. Don't hit yourself up. You should just pay attention to what the market is doing. For example, I wasn't paying attention to this part. You can see that we have a demand box here. So it is important for us too. We can take trades here until it comes and hit this box. So literally with this channel, with the knowledge that I'm providing you with, or in the future in mentorships or free other courses, you can ping pong the market. You can see that happening here. So here is our demand box. Let's see what happened. It comes down, it grabs this demand and it goes up. You can see that we have our supply box here and another internal demand box here, and even this is a demand box in lower time frames. You can see that work here. I wanted to mark this before it happens, but I thought maybe it's overwhelming for you today. What you can see that the market came up, it made a minor structure and it breaks this structure, so it is a minor demand box as well. You can see that we have another unmitigated demand box here and some kind of supply box here, and you should pay attention to this concept that it is our primary supply box. So anything here is a pullback. For your information, I don't go back and see how the charts work and then I come and show you these results. I have a very short memory. I even don't remember which trades I took today. I just know that I had 3 or 4 trades. I don't even remember which assets did I trade. So I don't scam these things up and for example look at these things on other monitors, or I go and I see the markets beforehand that I'm going to teach you. So these are all the things that I'm seeing right now with you, and you are seeing the results here. So these are the actual results that you may can take from the markets in the future when you got mastered in these concepts. You can see that it came up, it provided us a very good trade here. It came down, it provided us with a very good trade here, and it came up and it provided us with a very good trade here. It's named ping ponging the market. Now we have this supply box. I think it's going to fail because the market is trending up, but I don't know exactly how it will react. No, it became a demand box, so I'm going to change the color. We have another demand box here, and we have a big demand box here. It reacted to this demand box anyway, but we have a big demand box from here to here. You can see the results from this demand box. Another important thing is that if a demand box has imbalance before this demand box, we have an imbalance, for example, it is going to liquidate this demand box sometimes and react to this imbalance when that is the last demand box we have. So the prior demand box to last demand box is going to be important for us too, and that's correct for supply boxes as well. We have a minor supply box, not important, but anyway we can pay attention to this one too. Why? Because it broke this structure and you can see the results, And another thing I didn't pay attention is that we have a demand box here. You can see the results. We have a demand box here. It is ranging, and you can see the results. We have another demand box here and some demand boxes from here to here, and it created a supply box here. So it is the case study that we can try to always use. I mean, the case study. The case study is the best method. You can understand concepts one by one, and after that I'm going to teach you how you can go and backtest these concepts or forward test these concepts. We are going to teach you another level of market analysis and how to use these concepts together. You are going to be provided with another level of trading here in this channel. And I'm in an internet blackout in Iran. I don't have a stable internet connection. Always you can watch the news or see the news about that in the internet. We don't have something named an internet connection. I'm using VPN right now for trading view. So your support is much appreciated in these dark times, and believe me, you are going to learn concepts worse than I don't know 20 grand 30 grand of courses, because I paid for those courses myself, and I have 7 to 8 years in markets. I mean 7 to 8 experience of the markets, and I have 2 to 3 years of experience in teaching the markets in Persian language. So you are going to learn a lot of things. Another important thing that I'm going to add is that you should always use these concepts in higher time frames. For example, I know myself as a lower time frame trader, but I'm using 4 hour plus 5 minute time frame. You can bear the high volatility of 1 minute or seconds time frames in markets. That is just false information that gurus have told you. So try to use any concept that you are using in higher time frames. Even simple strategies are working in daily or 4 hour time frames, but when you lower your time frames, you are just gambling. So and we have a life to live. So when you are using higher time frames, you can read many books, you can spend a lot of time with your family, you can spend a lot of time studying about the fundamentals of the asset that you are going to invest in. That's so important for us that I'm talking about this right now in the early stages of this channel. So make sure to follow the higher time frames. Yes, these concepts work in lower time frames, and maybe on paper the lower time frames is going to provide you with higher rewards and higher profit rates, but the most important thing is that we are human. We don't come on paper. You can't calculate a human mind on paper. So we should pay attention to statistics, and statistics are saying that swing traders are the most profitable traders and have the higher rate of profitable traders. Anyway, make sure to subscribe to the channel. I'm going to provide you with information that you can believe it's available out there about fundamentals, about technicals, about even footprint and volume trading, because I've spent 20-30 grand on other teachers, and I have 8 years of market experience. Anyway, thank you for your watching. Have a good day and goodbye.